All right, we're also live on all of our streaming platforms. Wanted to welcome everyone to our webinar today. It's going to be talking a little bit about things to consider as your company goes public, thinking about going public. Lots of companies seem to be doing that right now, which we'll get into that in just a second as well. But before we do so, wanted to welcome in, of course, Nathan, our co-founder from DiversiFi. Nate, how are you doing?
Hey, Alfred, how's it going? Happy Friday.
Happy Friday. And then also in the back end here, helping those that are joining us through our direct webinar via Zoom, we've got Raymond, who will be helping us on the questions. He doesn't have his video on right now, but that's okay. Just wanted to know that, let you guys know he's here. You want to say hi, Ray?
Hey, everybody. Thank you for joining today.
Awesome. What a cool topic. We are always getting questions and fielding questions here about equity compensation. Why? Well, we are in the Bay Area, and it tends to be something that comes up quite often. And we've developed an expertise around here in helping clients be able to sort out the strategy, the thought process of their equity. So in 1 second, I'll tell you what we're going to cover in our webinar. But of course, as we're streaming here, I wanted to speak to those that are not our clients, disclaimers that, of course, because we don't know your individual financial planning situation, right? What we're talking about here is really strictly from an educational purpose only, especially around the tax purpose as well. So much of what is going into an equity compensation planning is tax related too. And we're not your tax preparers. We have people that we work with directly that help with that. And it's always good to ask your tax preparer these specific questions. And then finally, of course, when we talk about maybe diversification of some of your equity, it relates to what else you would be investing in, right? Now, don't take that as a solicitation to you investing in certain investment products or other things. It's just an education around, should I really be having that much equity in one company after it goes public, okay? So to start off, right, thinking about equity compensation and thinking about as your company goes public, what we're gonna talk about is even understanding what is an IPO versus a direct listing. So Nate's going to get into that in a little bit, but also breaking down the different types of equity compensation someone can have as they, or maybe granted throughout the time of, they're working at a company. How do they look at that and say, is that something I need to deal with now? Is that something I need to deal with after the IPO? Or can I just wait and not deal with it and see where the value goes? So there's some timing issues there. When to consider actions on it is also really important. So you'll hear us talking about things like before an IPO, during an IPO, and after an IPO. So we like to structure it in that way. But Nate, tell us a little bit, like IPO versus direct list. I think I commonly just use IPO, right? Like it's a term that I use, but actually tell us about some of the difference. Like, why is someone trying to take a company public?
Yeah. I mean, if you're watching this webinar, chances are you worked for a private company and they've gone through different fundraising rounds, right? One of the ways they do that is, well, they sell company stock to a large institutional investor. Could be Google Ventures, could be SoftBank, could be tons of venture capital funds out there. Now, another way to fundraise is to go through an IPO. An IPO is basically taking a number of shares that the company holds and publicly listing them. Doesn't mean all their shares are going to be publicly held. They're just listing a set number of those shares. And so that is another way to fundraise. That's the traditional path of an IPO. Now, when you go through that traditional path of an IPO, usually the company is hiring a JP Morgan, a Merrill Lynch, one of those big players to help them drive up the demand and list their company shares. But that investment bank is also taking a position in the company as well. And as part of their compensation package, not only do they charge a fee to the company listing through their services, but they're also going to want to require some minimal volatility on their shares. And so because of that, they're going to force on you as the investor, or sorry, as the insider, whether you're an employee, an executive, the inability to sell within 6 months. So they're going to say, hey, we'll help you. We'll drive that demand. We'll do those road shows with you. We're going to make sure you guys have as a successful IPO as possible. But hey, in return, we want to minimize how many people can sell right away. And so we're going to limit and say, hey, there's a 6-month lockup for you since you're going through this process. And again, the only reason for a company to go through that traditional process is if they're looking to raise an additional round of fundraising. maybe they have another growth initiative or whatever it might be.
Mhm.
But that's the major reason you're going to go through that 6-month lockup. It's the investment bank that's taking the position that wants to minimize that volatility for their position as part of the service offering that they're going to help you with that listing.
Yeah.
Now, there is companies on the horizon that maybe are not going to be doing a fundraising. Maybe they already raised $1 billion of cash or $500 million of cash, and they don't need to do the fundraising, but maybe they've just been or private for so long that it's just time, right? People have just been waiting for Palantir, for example, to go public for 17 years, right? And so for them, their rumors are that they're going to do a direct listing. And I think it might be confirmed at this point, but that direct listing is basically saying, hey, we're going to list, we're not going to require 6-month lockup, we're not going to pay an investment bank to do those rounds to drive the demand for us. We're going to save on that cost because, again, we're not fundraising. We're just doing a listing of our shares to be publicly traded. Now, the company can, if they choose, require some restrictions on your ability to sell after the initial IPO. But again, it's not the traditional 6-month lockup path in most cases. In the examples that you may want to cite, you can go back and look at Spotify or Slack. Those are definitely some of the more popular ones that we've seen direct listings actually take place for. But it is still by far much more popular to do the traditional 6-month lockup because the major reason companies go public is to raise money.
That's right. That's right. And think about that for 1 second, right? You have this, what it seems like a push for a lot of companies right now to be going public. And one of the reasons maybe that, while they may not be new banks investing or venture capitalists investing in these companies right now, over time, right, these companies have raised capital, right? A lot of capital in some cases. And those companies may be saying, look, it's time to go public because we need our liquidity back, right? I mean, the pandemic has affected all of us in different ways. And if you think about it from a financial standpoint, if you're over leveraged into these private companies, you're saying, guys, like we need maybe some of these cash that we've invested back. Why don't you guys go public? Markets seem to be doing well. Why don't you take advantage of it? And I think that's one of the pushes that we've seen lately to see all these companies at least thinking about being listed or filing to get listed. So just some insight on that, okay? Now, of course, we're personal financial planners, right? We're talking to you from a personal side, which means dealing with it from an employee perspective about what the equity that you have, right? And so there are different types of equity. You have restricted stock or RSUs. There's some minor differences sometimes between restricted stock and RSUs. I won't get into the detail here in this webinar, but that's one type. You have then stock options, both non-qualified stock option and incentive stock option. So the common question that we get from there, and Nate's going to help us with this one, which would be like, what do I need to be doing with that as my company goes public? Like, whether I'm vested, meaning I have the rights to them or not, like what should I be thinking about as I go through that? Maybe Nate, break down, maybe starting from RSUs and then go into the options.
Sure. Yeah. So with restricted stock units or RSUs, it is going to be a taxable event as soon as the IPO happens. So the reason it hasn't been a taxable event is the IRS actually requires 2 items to be met. The vesting, of course, we're all familiar with making sure that we've actually earned those shares.
Mm-hmm.
But since those shares are not public or not liquid yet, we haven't met the second threshold from an IRS perspective. But guess what? You do meet that threshold as soon as the IPO day happens. And so whether you had that 6-month lockup or not, you are going to be taxed at the price that the stock IPOs at for any of those shares that you vested already. And what will likely happen, or what should happen, is you're going to have some tax withholding applied to those shares the day that that takes place. Oftentimes it's referenced and called sell to cover. So depending on the state, it might be slightly different as far as what that total withholding is. But if you're referencing California here, oftentimes we see a 40% threshold. Something like 22% is withheld for IRS. If you make more than $1 million, it can be as high as 37% withholding. And then state withholding, Medicare, Social Security, state disability, et cetera. But what you will also find for a lot of you out there is that 40% may seem like a lot, but it's actually not. It may not actually be enough on the IRS side because that 22% might not be enough. But not to get too far into the weeds on the tax component, I think what we're trying to help you understand is, again, it is a taxable event.
Yeah.
And so you're going to be taxed on the day that the shares are first listed at the price that they're first listed. So that's something to keep in mind. Regardless of any action that you do, you're going to incur that taxable event for any vested shares.
Absolutely. And I think you noted it there, which is not to get too much into the weeds of the taxes. And it's understanding that that's a point. If you're confused about whether you're going to be taxed or not, that's where you reach out to your tax preparer and be like, I have this event going on. They should recognize that this is going to be an event and let you know further details. But again, the general overview is that you have to be certain that the default withholding is just an estimate. We talk about that all the time in that whatever is withheld from your paychecks or bonuses, this concept, like this idea that bonuses or overtime gets taxed more than regular. They're all just ordinary income. It's just the way that it's withheld and estimated to be withheld can be different. And oftentimes is not exactly what you owe. And that's what we're talking about here, is that understanding what you actually owe versus what they're withholding for you is going to potentially vary. And to Nate's point, you don't have a choice with the RSUs. You know what? Good for you though, right? Like if you have RSUs that are hitting and it's going public, it's a good thing because likely, right, we're getting a little payday from it, but it is going to be something that is taxed to you. So how does options differ, Nate? Like how does that change in terms of the treatment of the options?
Yeah, so it's kind of the exact opposite, right? So with options, it is based on your decision of when to exercise those shares. It's not until you actually exercise those shares and they become your shares that it becomes a taxable event. The tax is going to work a little bit different depending on if it's NSOs or ISOs, but the most important takeaway is that those options are not a taxable event until you choose to do so, whereas the RSUs, you don't get to choose when that tax event happens. That could be a positive, that could be a negative. For me, I prefer to have that control aspect of when I incur my gains, but that's something to keep in mind. And I think for a lot of people that are heading towards that IPO within the next couple of months, because there are so many of them, you probably see a lot of the people watching have options.
Yeah.
And so that is helpful. With those options though, just to maybe broad strokes, make some distinguishments between the two. With NSOs, you're always going to pay essentially ordinary income tax rates between your strike price and the price that you eventually exercise at. And so this is probably getting into the third section just a minute, but if you think that your shares are going to have a huge spike, you might consider exercising early to minimize the percentage that you pay ordinary income tax on. Yeah. Now that could be a risk because you are going to have to pay some tax and potentially you're going to want to receive shares instead of receiving cash. And so you might put yourself in a position where you are paying tax on more than you need to if the stock ends up going down. So that's certainly a risk. The ISO side, it is kind of different. It's an AMT tax. So it's a little more complex, but with the AMT tax, you're essentially paying a tax up front. And if you hold those shares after exercising for a year, you can retroactively gain long-term capital gains tax treatment from the strike to the FMV of what you exercise at. Again, I don't want to go too far into the weeds, but ISOs are preferred over NSOs, given the flexibility of potentially being able to exercise and hold for at least a year to retroactively get some preferred tax treatment. But again, neither is without risk if we're doing any sort of exercise and hold strategy.
You did a really good job, Nate, explaining two very difficult topics in as simple a form as possible, right? Like, I'm going to summarize by saying this. You have a choice to make with your options of when the taxes are held. The longer you wait, there could be more upfront cost that is paid. However, if your company is liquid, they may have an option for you to just sell everything. They cover all the taxes on the estimate, they cover the exercise, so you may not have to do anything upfront, okay? But if we're talking about efficiency, if we're talking about tax efficiency, then there's the trade-off that Nate's talking about in terms of risk of me taking my own money before the company is public, putting it in, maybe paying some taxes on it, but that tax might in the end be lower than what you end up paying in the future. So it's about efficiency. And that's a calculation that we talk about with our clients. But if you're not our client, it's a question you should consider and think about. Do I have money on the hand right now where I'm willing to invest in my company for maybe a 1 year, 1.5 year holding period to get some tax efficiency? Am I okay with 50K, 60K, 100K where I just put in and don't look at it for that 12 to 18 months, knowing that if the stock goes up, I'm going to benefit from the different tax rates. And generally speaking, from a federal perspective, you might see somewhere between a 15 to 17% difference in taxes. And we talk to our clients, be like, okay, that 15 to 17% difference, I'd like that, with the trade-off being I don't have access to this cash in the meantime, which also might mean that you're not invested in whatever you were in with that cash prior. So just general stock markets. So you're going to lose out on that, right? So that's the trade-off that we talk about. But again, between the equity that we're discussing here, RSUs not really having a choice, right, in terms of the tax liability as it goes public, NSOs and ISOs having a little bit more of a choice, and the longer you wait, you may have more of an issue there with taxes. But talk about this for a second, Nate, right? What are some driving factors, right, that would maybe force you to exercise, like expiration, your employment length, right? Like what are, or your fair market value increases, like even before a company goes IPO, some of those points that might drive someone to take action?
Yeah, I mean, expirations has been a really troubling thing for some of these companies that have been private for longer than a decade. And so with option expirations, it is a hard 10-year expiration. There is nothing the company can do to extend beyond that 10-year. But let's say some options are 7, so 7 or 10 years, just to elaborate on that. And that is from the grant date. So just as an example, let's say you were granted something in 2010, 10-year expiration means it's expiring in 2020, meaning we have to exercise, otherwise we lose these options, and that's just money wasted. And so that becomes troublesome. With some of the option expirations, what if you leave your company?
Yeah.
That's where people really get into some headaches. For most companies, it's a 90-day window where you have to take action. If you wait until day 91, you've just lost all of your options. There's nothing the company will do to extend that for you. Now, there are some one-off companies that do allow for longer extensions, maybe a year. In some cases, the longest I've seen is 3 years. But again, if you're running up against that 7 or 10-year hard expiration, they can't extend it beyond that.
Yeah.
And so you have to exercise, or you would go and reference a company like SecFi, Troy Capital, Equity B, who maybe provide you a loan, not a free loan, but a loan to pay for the exercise and the tax cost. So there are some platforms to allow you to minimize how much cash you put up front to take possession of those shares. But those expirations are crucial. I've seen people come to me on day 91, not being my client, and say, hey, I totally forgot about this window. Can I do anything day 91? And I just feel so bad for them.
Yeah.
There's just nothing we can do. So you have to be very, very cautious if you do decide to leave, or if you're coming up against that expiration.
Yeah. And so how do you find that out? Ask your company, what are the company policies? It might be an awkward thing to ask if you're leaving, right? But you know what? Somehow, some way, right? Exactly. Somehow, some way, you should read the documents. It's in there. It's in your grant documents that show if you leave, how many days that you have. And generally, the 90 days applies to incentive stock options. The NSO side of things, right? They can apply the same 90-day, but if Nate was saying the one-off flexibility, generally the one-off flexibility is not around the incentive stock options. They would either convert them or change them to NSOs. And again, before they convert and change them, that's another point of inflection where you're like, do I want to exercise any before they convert? So you could see some of it in terms of deadlines, maybe driven by you. Like, you know what, I've worked here really hard. I'm ready to go. Like this, I'm ready to switch to another company. That's going to help drive to say, I probably need some advice, or at least ask the right questions on that. I had a question come through, and I can help answer this. It was a question about the single and double trigger topic that you talked about with the RSUs. And what we're really talking about is, if you're working for a public company and you had some restricted stock RSUs come in, both the vest date and what they consider like release of shares to you are at the same time. And so because of that, it's taxable to you. In a case where you're in a private company, the vest date of the share, so you own the rights to the share, but they haven't been released to you, because of the release portion of it not happening, it's still at risk to be lost, I guess is what they consider in the IRS. And so because of that at risk to be lost and not released to you, they say, we're not going to tax you yet. We're going to defer that for a little bit. Okay. There are other things that that you could do with the RSU to say, I want to elect to pay taxes on it upfront, right? To say pay tax on it early and lock in the price on that. I won't get into that, but it's a special election you can make on these things to say, I just want to pay tax on it now and not deal with it in the future. But in general, you're going to be, for someone who didn't do anything with the options or RSUs, and you hit the vesting trigger and the release to you trigger, that's when the taxes gets applied, right? And so, awesome. So we spent a lot of time thinking about maybe a little bit of the pre-planning, or at least questions to think about for the different types of equity. Now that I've gone public, or the company's gone public, right? You're going to have a question of, wow, all of a sudden, maybe my net worth just jumped up. Okay. So maybe Nate, talk a little bit about like a threshold or a benchmark to say, how much of one company equity should I really be holding, and elaborate from a net worth perspective? Like how would we think about it for a client to say, do they have too much?
Yeah. I mean, I've seen clients come to me with 90% of their investable assets in one company stock or more. It might seem extreme, but we generally advise no more than 10 to 15% of your net worth or investable assets in one company stock. I mean, by textbook, anything greater than 10% of your investments in one investment vehicle is a concentrated stock position. Now, it can be challenging to get to that lower threshold if you worked at a company for a long time and its IPO just happened. But we would encourage you to work your way towards that 10 to 15% as best you can, especially if you still work for the company. I mean, our worst case scenario is, what if the company stock does poorly? Because the stock did poorly, maybe management is having to work on cutting costs, and that's at the expense of you as the employee. And now not only do you have a huge drop in your net worth, but now you are looking for new employment. That's a very bad day, and we don't want that very bad day to take place. Now, a lot of people will say, well, look at Amazon, look at Google, look at Apple. If I was an early employee at those companies, I'd be a billionaire by now. And while that might be true, there's probably a dozen examples of companies that are out of business that have IPO'd as well. So Wealthfront did a fantastic study looking at hundreds of IPOs and the potential outcomes of, when is the optimal time to sell. And their conclusion was to sell right away, all of it right away. Now, for me, I think that's a little bit extreme.
Yeah.
It's a really tough mental decision for anybody to make. That's a lot of emotion, especially since you probably worked at the company and put your blood, sweat, and tears into the company to make this windfall for yourself. But I generally try to recommend somewhere between a third to a half being sold right away. And then maybe think about dollar cost averaging. So, taking equal increments of the rest of it out over the next 12 to 24 months. Yeah. That way you're still participating in some upside. And especially if you still work for the company, it's a lot easier to make that decision, because generally you're still vesting additional shares also. So it's not like if you were to sell everything that you're not participating in the upside of the company stock. All of your unvested stuff is participating in the upside still, assuming that you will eventually vest it as you still work for the company. So a lot of people forget about the unvested shares being worth more and more and participating that way. But that's a general thought. Try to get to 10 or 15% or less. Take a good chunk off the table that first initial IPO day, and then maybe dollar cost average out over the next 12 to 24 months. Yeah. So that, I think, is the safest advice.
And remember, when we say dollar cost average out, I'm not saying dollar cost average out or sell the initial 30, 50% and sit in cash. No, I'm talking having a plan to reinvest that. And what you're doing, and it's a good point to make, and just elaborate on that too, right? You and your company fully is 100% or more than 100, risk number, let's call it. Right. You going cash after you sold off is 0. Right. That in itself is a huge risk to take, to go from 100 to 0. So what we're really saying is you can diversify and take less risk in your company and still be taking risk. Okay. And I think that's, people forget that. They're like, oh, selling cash and then I'll wait to go back invested. Fine. And I was like, no, don't wait to go get invested, because don't market time, right? And so if you sell from your company stock, which it's all about relative point, it was relatively previously in stock, 100% stock. And thus you should have the ability to say, I'm going to diversify and sell off, and maybe even put it in index funds, equity funds. You're still in stock, but now you're in maybe hundreds and thousands of overall all stock market, which would make you hopefully, and of course you as your planners for clients that we're talking to, much more comfortable about the fluctuations. Okay, Nate, you know what was interesting? I got an email from a client, and we've talked about like strategy for selling, and I'm going to describe that in 1 second. But what was interesting was after we talked about certain price targets and setting certain things, the emotions still came through, because one of the things that they said in the email to me was like, well, as I'm going through day one, this all makes sense, but how do I know what's the highest point to sell on that day? You don't know what the highest point is, right? You don't know what the highest point is, right? And if you set yourself up for that highest point of that day, you're setting yourself up to be disappointed. And I wanted to explain that to that client, but also to you guys as the audience, that it's not about finding the highest point. It's about finding a point in which you're saying, I'm comfortable leaving, selling this no matter what's going to happen at X dollars a share. I'm realizing some value. That value is going to mean maybe a material difference to me from a financial planning goals perspective, regardless if tomorrow is going to go up 50%. And I say that, of course, if it does go up 50% the next day, it's going to hurt a little bit, but at least when you went in to make that decision, you made it for the right reason. I made it for the reason I sold off 25%. Goes up 50% tomorrow, guess what? I'm going to sell off the other 25%. Having these structures for yourself on day one as you go public is going to help with some of the nerves. I'm going to say some because you're still going to have nerves, but it's going to help with some of the nerves. But I thought that was interesting, Nate. Like, we've come up with plans and talk about that. But look, the reality is, right, for you viewers talking to you guys, is that the emotions are real, right? The emotions are going to be there, and you're not going to find the highest point. It's not about that, but it's about talking to somebody, looking at your portfolio yourself and say, like, if it's at $20 a share, it's going to represent 89% of my overall portfolio. That's too much. And I think that in itself right there will help you determine how much to sell off.
Mm-hmm.
Okay. Yeah. So now
maybe a few other items.
Yeah.
Just to touch on. Now there's a dozen at least companies in Silicon Valley, San Francisco, going public in this next month or two. There is some potential that there are some psychs out there. Like, actually, we're not going public. We're getting acquired instead, right? So just to speak to that real briefly, I mean, that was, what was it? Postmates got acquired by Uber Eats after potentially heading towards their S1 filing. Not Uber Eats, but just Uber in general. And so it is possible some of these other companies got acquired before they actually filed their S1 and go public too. So just to quickly speak to how that works, there's 3 ways that you would actually transact from what you have to what you eventually will have. One of them is just a conversion of your current company stock to that new company stock. Some ratio is going to determine what is that appropriate conversion rate. The second one could be an all cash deal where the new acquiring company just buys out all of the stock of the acquired company and you just receive cash, and there's 0 tax efficiency that we can do there. Whereas with the first one, if you're receiving that company stock, you haven't sold anything yet. So we still have the ability to be efficient potentially with those shares. And then the third one is just a hybrid. I've seen some where it's a conversion to company stock and a cash deal. You won't know that until that deal is structured. So there's nothing we can really do to plan around that. And oftentimes acquisitions are announced so quickly, and then there's really not much planning, definitely within a year, for any sort of exercise and hold strategy to be implemented. But I just wanted to put that out there because it happened to those people that were at Postmates this year, and it can certainly happen to some people watching this webinar as well.
Absolutely. And that's, it also takes the control out of, right, the taxation potentially if it's all cash, and takes the timing. I mean, we've had cases where we've planned to exercise and hold, and then our client's company got acquired 9 months in of that strategy. Everything was still short-term gain, and you just have to prepare for things like that. And I think a saying that we have is sometimes not doing anything is a strategy. I'm just saying though that if you decide to not do anything, hopefully it's because you've evaluated what you could do and know that not doing anything for you is the right strategy for whatever reason. I don't have the cash on hand. I'm not willing to invest in it. I mean, all these things are reasons why you don't do anything. But oftentimes a lot of people come in initially when they talk to us, they're not doing anything because they're just unsure. There's just so many questions. And that's a hard feeling to have. And that's why we're having these webinars, but also why we work with clients directly to build their own strategy. Right? And so
maybe one other confusion that could come up is the idea of reverse stock splits.
Yes, yes.
So obviously people saw in the news, Tesla did a stock split and Apple did a stock split earlier this week. Apparently that drove a bunch of value into those companies. I don't get it. It really doesn't. But it is possible that your company does the opposite of that, because chances are the last 409A valuation maybe put your stock price at like $4 or $5. Very rarely do you see a company actually go public below $10 a share. So just to make it more appealing to investors, I have seen companies do reverse stock splits just prior to an IPO event. Now, that's not supposed to change the value in those shares whatsoever. Essentially, if they're doing a reverse stock split, you have shares that are worth more, but now you have the equivalent amount less of shares. Right. So your value is exactly the same. So don't let that confuse you. The fact that Apple and Tesla had a huge run up after the news of their stock split is totally confusing. But maybe that's just the irrational market that we're in right now. Right. So I just wanted to clarify that for people that might go through the opposite effect of that.
I think that's really helpful. And I think, as you go into understanding like how your stock will move, I think that's the point that Nate's making, is that sometimes it's not going to be rational how the stock moves in the short run. And that should help you make determinations that if there's a bump up or bump down, look, you have zero control of that initially. So setting price targets for yourself on day one, on week one, whatever the case may be, and writing it out is probably one of the most helpful things that we go through with our client. And you could do it yourself to say, at these price points, this is what I'm going to let go, and try to stick with that. Because otherwise there's going to be a lot of wine bottles opened and be like, I'm really stressed out, right? Like you have to, try to take it with a grain of salt that you're not going to find the perfect timing for it. But what does it mean for you in the long run? I think one final thing, Nate, that I wanted to cover, and you let me know if there's anything else that you wanted to add on, but there's a big one right now because of the work from home situation, that you may not need to be in a certain area, specifically in California or some of these high income tax states, and you want to move out and try to limit what is taxable to California. Big caveat there, okay? California is going to want their taxes in many, many scenarios. It is very difficult, especially if you've worked in California or New York or wherever, whatever the state is, right? A lot of the state rules are similar. But if you earned that equity compensation, RSU, NSO, ISO, you earned it, meaning you vested it, right? While you were in the certain state. Just because you move and you're not here anymore doesn't necessarily mean you don't owe that state any taxes, okay? There are some strategies, right, in when that might be true, right? When is it a situation where you might not have the state tax? Again, that's for a much more detailed conversation. But if you were thinking, you know what, my company's IPOing next month, I'm ready to move, I should move now, okay? Double check that with your tax preparer before you actually make the move, because what you might think is true and not paying state tax may not actually be the case.
That's a great call out. Yeah.
Awesome. And so I'm going to close this webinar off by saying, again, we try to do our best to generalize a webinar and give you guys as much educational information as possible. That's what we really want to do in these webinars and streams. But at the same time, if it's something that comes up where this has perked your interest, these are questions that you realize you didn't have, but now you have, right? In terms of like how to be able to plan, let us know. We try, as a company goal, as DiversiFi, we want to make education as accessible to everybody, right? And in cases like this, we realize that you might, be in a situation where you're younger and you don't have all the financial planning needs maybe a full family does. Don't worry, we have an equity compensation kind of structure where we're just addressing with clients what we talked about here today, you know, and not having to focus on things like education planning, right? Or estate planning, other things that are important to other people. But in your case, you just want to know what to do on day one, week one, year one. That equity compensation piece is right up your alley. Okay. From that, if you're ever interested in scheduling a time with us, right, you can visit us on our website at diversificapital.com. We're also going to have our team link to the video itself on our streaming platforms. If possible, the Wealthfront study. It's a really good one that Nate referenced, and I think that you guys should take some time to read up on that as well. Okay. Nate, any closing remarks? Anything to add to this?
I mean, I think we could go on for hours.
I know.
But I think this was good broad strokes for now.
Yeah. Awesome. Well, thank you so much, Nate, for joining us. Thank you for the audience joining us as well as our clients directly in our webinar. We love having you guys here. It makes it really enjoyable, and we look forward to having you guys on our next webinar segments.
Thank you.